Hello Accounting 101 students. In this video, we are going to go over how to compute ratios using the Chapter 2 end of chapter practice exercise, question number 5. The reason why we compute ratios is to compare the financial amounts for one company to another company or from one year to another year to assess how a company is performing. And we have three major types of ratios. We have liquidity ratios, solvency ratios, and profitability ratios. So you also want to be aware of what it is that you're computing. So in this problem, we are given some data. The data that we're provided with is coming from the financial statements. So you would be looking at the balance sheet to find the current assets and total assets, current liabilities and total liabilities. You would be looking at the income statement for the net income. You would be looking at the statement of cash flows for the net cash provided by operating activities, capital expenditures, which basically means the purchase of property, plant, and equipment. And you would be looking at the statement of cash flows for the dividends paid on common stock. You would also look at the annual report for the weighted average shares that are outstanding. The first ratio that we're going to be computing is the current ratio. And the current ratio is going to be a liquidity ratio. So it measures the company's short-term ability to pay its upcoming debt and also meet unexpected needs for cash. So for each of these ratios, you need to know the formula. For the current ratio, it will be the current assets divided by the current liabilities. So we are looking at the proportion of current assets divided by the current liabilities. And in your chapter, you also learned about working capital, which is your current assets minus your current liabilities. And this is looking at it from a dollars perspective. So we're going to do our calculation for 2017 using this data. So we're going to take our current assets, which will be 917,700, and we're going to divide that by our current liabilities, 437. And you should always have a calculator with you when you're working on items for your accounting classes. In your calculator, you will end up with 2.10. And a singular measurement doesn't really tell you a lot unless if you have something to compare it to. So now we're going to do our calculation for 2016. And we're going to take our current assets of 910,000 divided by our current liabilities of 350,000 to get our current ratio of 2.60. And this tells us that in 2016, the company is doing better because they have a higher current ratio. They have more current assets compared to their liabilities in 2016 compared to 2017. So for the current ratio, we're looking at our current assets and our current liabilities. The next ratio that we're going to be talking about is the earnings per share ratio. So I'm going to scroll down a little bit for our earnings per share ratio. And for our earnings per share ratio, this is going to be a profitability ratio. So it will tell us about the operating success of a company over a period of time. So we have earnings per share equals our net income from our income statement minus our preferred dividends. So if you don't see the word preferred and you see dividends, just include 0. Most of the examples in our introductory accounting class will have no preferred dividends, so it'll just be 0. And you're going to divide that by the weighted average shares outstanding. And we're going to go ahead and compute this for 2017 and 2016. So we're going to get our net income from the income statement typically. So in this example, it's $162,000, and there's no preferred dividends. I see dividends paid on common stock, but no preferred dividends. And then I'm going to divide that by our weighted average shares outstanding. In this problem, it's given to us. So when you do the math, you'll end up with 0.79. Make sure you round to the number of decimal points that Wiley indicates in the problem. For 2016, we have our net income, $375,500 minus 0. There's no preferred dividends. And we're going to divide that by the weighted average shares outstanding of 217,000, which will give us 1.73. So this tells us that the company had higher profitability or better profitability in the year 2016. And one thing to note is if you're not given the number of shares outstanding, or if there's any time in this class where you need to compute the average, you're always going to take the current year plus the prior year amount or number and divide it by 2. So sometimes you might have to compute the average if they didn't give you the average. So you can see in this problem we were actually provided with the average right here. The next ratio that we're going to be going over will be the debt to assets ratio. And for our debt to assets ratio, we're going to present this as a percentage. And our debt to assets ratio is a solvency ratio. So that tells us about the company's ability to survive over a long period of time. So I'm going to get started with our solvency ratio. Actually, we're going to have 2 solvency ratios. The first solvency ratio we're going to go over is our debt to assets ratio, which is going to take our total liabilities, which we're going to get from the balance sheet, divided by our total assets from the balance sheet. So we're going to do our calculation. I'm just going to move these notes up. That way it's easier for everyone to see all of our work. And for 2017, you're going to take your total liabilities. Make sure that you don't get this flipped. You take your total liabilities first, and then you're going to divide that by your total assets. So sometimes I have students that get this flipped backwards, okay? Or they look at the current instead of the total. So 587,800. If you're not presented with the total liabilities, you would take your current and your long-term liabilities and add them together. And you're going to divide it by your total assets. And for 2016, we're going to take 502,300, and we're going to divide that by our total assets. And you can take some time doing the math. One thing I want to point out is that for our debt to assets ratio, you want to have a lower number, not a higher number, because you want to have less liabilities in proportion to your total assets. So keep that in mind as well. And you can see that with our debt to assets ratio in 2017, we have 29.7%. So you need to convert the number in your calculator into a percentage. And you can see that the company did better in 2016 compared to 2017 because a lower number is better. All right, so just going to put a little box around this number right here. So the last ratio that we're going to be covering is the free cash flow. The information for the free cash flow is mainly coming from the statement of cash flows. I want to make sure I color code this. So we have a free cash flow. And our free cash flow is going to be a dollar amount where we're going to take our net cash provided by the operating activities minus the capital expenditures. So that's the amount paid for property, plant, and equipment minus the cash dividends that are paid. So this information is always on the statement of cash flows, and you can go to our data to find our information. It's basically going to be subtracting these mathematical amounts. So for the purpose of fitting everything into one area, I'll compute our free cash flow right here. So our 2017, and this is our calculation for free cash flow, is going to be our net cash provided by operating activities, 288, minus our capital expenditures, 264. That's the amount spent on property, plant, and equipment in the investing activities, and our cash dividends that is going to be reported in the financing activities. And for 2017, your calculation will be similar, and they're going to be getting this information from your problem. So I'm going to take our cash flows from operating activities minus the capital expenditures minus the dividends paid. And after you do the math, you want to notice that for the free cash flow, a higher number is better. So negative 60,000 compared to 92,600. So just notice that having a higher number is better. So our 2016 number is better. So thank you for taking the time to watch this video. So I'll put in our negative 60,000. And for this one, we have 92,300. All right, thank you everyone, and I hope this helps you in getting started in computing your ratios.
Recording stopped.